Okay, so the housing market, it's at a major turning point. For mortgage professionals, the old rules just don't really apply anymore. So today, we're going to crack open the new playbook for not just surviving, but actually thriving in this new landscape. We'll look at the strategies, the mindset, and a key financial tool that's really reshaping the entire game. So, what's the secret sauce here? How are the top players actually rewriting the rules? You see, as interest rates start to ease up a bit and confidence creeps back in, it's not about just sitting around and waiting for the market to do all the work. It's all about adaptation, creativity, and a laser focus on what you can actually control. Let's break it down. All right, first things first, let's set the scene. After a couple of years of, let's be honest, a lot of uncertainty, the ground is finally starting to shift. You can almost feel this new sense of optimism in the air. So what's behind all this new energy? Well, we've seen a couple of recent rate cuts, and pretty much everyone expects more to come. This is huge because it's pushing first-time homebuyer rates down into that much more manageable 6% range. And it's reopening the door for all those refinancing conversations that went quiet. I mean, phones are starting to ring off the hook again. Open houses are buzzing, and deals that were totally on ice are suddenly getting hot. And look, this isn't just some abstract theory. As Kimber White over at Refinancial Services puts it, people are adjusting. That sticker shock from the high rates, it's finally starting to wear off. Borrowers are getting comfortable in this new reality, which means it's a psychological shift just as much as an economic one. And it's not just a vibe, right? The numbers are absolutely backing this up. Kimber White says he's seen a 30 to 40% jump in his loan volume in just the last couple of months. That's not just a little bit of growth, that is an explosion of pent-up demand finally being unleashed as buyers decide to get off the sidelines. And this brings us to a really crucial point: realism. According to Nancy Aguirre at Your Better Mortgage, people are realizing that sitting around forever, just waiting for prices or rates to magically plummet, well, it just isn't a winning strategy. There's this new level of acceptance, and that's exactly what's pushing them to take action now. Okay, so we know buyers are coming back into the fold. The big question is, how are the smartest originators changing their game to meet them? Let's dive into their new playbook. Well, it really boils down to three core strategies, and they're all about focusing on what you can control. First, they're refining their operations, making everything faster and way more efficient. Second, they're strengthening those key relationships with real estate agents and financial planners, becoming absolutely indispensable partners. And third, this one is critical. They're doubling down on education, for themselves and for their clients. It's really a back-to-basics approach that's built on pure discipline. And, this quote from Tom Aholes at Edge Home Finance, it just perfectly nails this mindset. He says, "I can't control what the market's going to do. Keeping our heads down and focused on what we can do today is the biggest thing for me." See, the real opportunity isn't in trying to predict where rates are going to go. It's in providing undeniable value, right here, right now. So when we talk about getting smarter with operations and really educating clients, there's one tool that's becoming a massive game changer. It's going from this niche little thing to a core part of the business. And that tool? It's the non-qualified mortgage, or non-QM for short. So what on earth is a non-QM loan? Well, to put it simply, it's a mortgage for folks who just don't fit into that traditional cookie-cutter box. Think about self-employed entrepreneurs, gig economy workers, or real estate investors. People whose income doesn't come from a neat and tidy W-2. It's a solution for a huge and, frankly, growing part of our workforce. And this right here just lays out the difference so clearly. Traditional loans, they're built for the standard W-2 earner, but non-QM loans, they offer flexibility. They let you qualify using things like bank statements or other assets. So that freelance graphic designer with an income that goes up and down might get a hard no for a traditional loan, but a non-QM loan could be the very key that unlocks the door to their dream home. It's an absolutely essential alternative path. But how big of a shift are we really talking about? Well, just look at this. For one originator, Eric Lieberman, his business is now 80% non-QM, 80%. That is a massive, massive change. It shows that this is no longer some fringe product. For him, it's become the primary driver of his entire business. And you can hear it directly from Eric himself. He says when he started out, non-QM was maybe 10% of what he did. Now, it's 80%. And here's the kicker. He busts a common myth. He says while borrowers might think they're going to pay a way higher rate, he shows them that the rates are actually very, very competitive. Okay, so if non-QM is this amazing tool, what's the catch? What's holding it back? Well, according to Kimber White, the single biggest barrier isn't a lack of demand from borrowers, it's a lack of education among the loan originators themselves. And that's a huge wake-up call for the industry. The demand is there, but the question is, are originators ready to meet it by really mastering these products? And listen, the potential here is it's enormous. Most homeowners are sitting on an average of 50% equity in their homes. Non-QM products are a way to tap into that wealth, to fund another property purchase, to finally do that big renovation, or to consolidate all that high-interest debt. It's a massively underutilized tool for unlocking real financial flexibility. All right, so let's tie all of this together. What does the road ahead look like from here? Honestly, the outlook is feeling overwhelmingly positive. What we're really seeing is a market that's being reshaped by smart, savvy adaptation. Originators are diversifying their toolkits with things like non-QM, and they're getting back to the fundamentals of education and building strong relationships. It's this powerful combo of innovation and discipline that's building some serious momentum. And that really leaves us with one big, thought-provoking question for the future. As those lines between conventional and unconventional borrowers keep getting blurrier, and as tools like non-QM loans become more and more mainstream, you have to ask, could the so-called unconventional homeowner actually become the new normal?